Hey guys, what's up? I'm Erin and welcome back to the channel. Today I have a very special guest on this channel, Mr. Paul Merriman, who is an expert when it comes to investing as an indexer, asset allocation, and we are so fortunate that he is taking time to share his knowledge with us today. But before we dive in, can I ask you for a favor? If you're a regular watcher of these types of videos and you keep coming back every single week, can you check and make sure that you've hit that subscribe button? Many viewers think they have, but they haven't. So if this is some content that you're interested in and you keep coming back, please make sure to hit that subscribe button because it really does help the channel. I appreciate you and I thank you, and let's dive in. Today I have a very special guest, Paul Merriman, who is the founder of the Merriman Financial Education Foundation. And if you've read any of his books or seen any of his teachings, you probably know him. Got a solid reputation in the financial investment community, and I am so honored to have him here today. So welcome to the channel.
Well, Erin, thank you so much. I am thrilled, really, to be here with you.
Oh, thank you. Thank you. Do you want to start by giving us a little bit of what your broad investment philosophy is?
Well, yeah, the broad investment philosophy, because I'm teaching people to do this on their own. That's the focus of our work. But it is to be broadly diversified, keep the expenses low. Ever thought of that? Of course. I also want you to be tax sensitive. I want you to be committed to buy and hold. I don't want to hear about any market timing. I want you to understand the pitfall. Well, I guess I want you to understand that Wall Street is really not on your side most of the time. So I want you to be an independent thinker and a disciplined saver. Other than that, it really is a very simple process.
I love every single one of those. That's pretty much what I feel like I go over on this channel. So I feel like you fit right in with the overall message. You often say that saving early is $1 million decision. So for young investors who feel like they can't save much, how do you help them grasp the power of small steps early on?
You know, I think when I do workshops and I teach a lot of college classes, that the one thing they walk away with of everything I tell them is the amazing impact of starting early. We just don't often, most of us don't understand compound interest and how it does this magic thing. But if you start just investing $100 a month
Mhm.
at age 22, and you did that until 67, that's $1,200 a year, and you got the market return with that money, you would have almost $900,000. Now, that's the good news.
Mhm.
The the other good news, if you do believe in starting early, is the first 5 years, 1/9 of all the money you put in represents 69% of the value of the portfolio.
Wow.
So that's a life changer. I
Yeah.
don't care whether that means you retire sooner, you retire with more to live on, you leave more to others. The bottom line is you get probably at least, one more double coming out of your money.
Yeah. I heard about the just invest $100 a month in ninth grade. I was in Mr. Hill's econ class, and we had a segment of the class where we got to play with the stock market. You were given a fake $1 million, and we had a little competition between everyone. But ever since that, that is really what lit the fire for me investing. I was so blessed that it happened when I was in ninth grade. I think at the time I was 13. So, I mean, I've been investing since then.
And that made an impression on you at that time, obviously. And by the way, if I'm not mistaken, you have a young child
Yep.
in your family. And I want to just share this invest early concept. It isn't just for 21-year-olds, but I do a lot of work encouraging parents to start putting away $1 a day and saving that eventually to go into a Roth IRA.
Mhm.
But it is amazing that if we get a 10% return and we put away $365 a year
Mhm.
for 65 years, it turns into about $2 million.
Mm-hmm.
If you wait until that child is 10, it turns into about 750,000.
Wow.
If you wait until they're 21, which is how a lot of parents and grandparents think about this,
Mm-hmm.
it turns into about 280,000. So this starting early, you mean the good news is we can start really early if we choose to.
I bought my son a onesie that said compounding from the crib on it. And in lieu of gifts, I have all family members just give any kind of amount of money they want. Some give $20, some give $50, but that goes into his investment account. And I just want it to grow for him because that's going to be more important than another toy. He has enough toys.
I think that's great, but I have to ask because I specialize on helping people build portfolios.
Yeah.
How do you divide that money that you've invested for him?
I just do a traditional brokerage, low cost investments, and keep it in a trust. So,
But do you do all equities,
yep, 100% equities.
S&P 500,
Total stock market fund.
total stock market?
Mhm.
Okay, no special small cap value there at all?
Nope, just the total stock market fund. I'm pretty much as simple as you can get. I once heard the phrase VTSAX and chill. That's
Yeah.
what we're doing.
Well, I will just share that our newest granddaughter, when we gave her 401k money when she was born, her Roth IRA money,
Yes.
we split it 50-50 S&P 500
Hmm.
and small cap value.
Okay.
And when she sees at age 18 how she did,
Hmm.
she's going to be able to see the ups and downs of a diversified portfolio. So that was our answer, but I think what you've done is great.
Well, we'll have to do a phone call in 18 years and see how they
Okay.
did. But I think at the end of the
Good
day,
luck.
they'll both be winners.
Could you speak up, please?
So you do mention, speaking on different portfolios, that every 10% that people put into bonds reduces the expected return by about 0.5%. What's your reasoning in saying that 100% equities for the first, say, 20 or 30 years of investing is the way to go?
Well, it's interesting. This was one of the most important parts of my conversation I had in 2017 with John Bogle. And that was I asked him, how can you, for a 21-year-old, justify putting 10% of the portfolio in an instrument that is historically going to, under the best of conditions, make half of what the stock market makes? So that if you make 10 in the market and you make 5 in bonds, that is going to cost you a half of 1%. And to do that for 20 or 30 years has an impact on what that portfolio is going to eventually be worth. And the answer was interesting because it made me understand something about him and what he was trying to accomplish. He said that we understand that,
Mm-hmm.
but we have investors who don't know much about the market. And our job is to get them comfortable. And we were talking about target date funds, which I just love, but making people comfortable with the knowledge that they know we are going to be taking care of both the equity and the fixed income, and that we begin with a very small amount.
Mm-hmm.
And hopefully, when the tough times come, that small amount will be enough to keep them believing that the Vanguard people are doing the right thing.
Gotcha.
But the fact is, when you have that 10% in bonds and you're protecting a very small part of the portfolio
Mm-hmm.
from loss, you're also keeping the investor from putting that equity dollar cost averaging
Mm-hmm.
into equities at points when it's really good
Yeah.
to be putting that money in there. So my view is that if I could, I would not have any fixed income. Well, and let me just make an interesting point. The difference between having 90% in equities and 100% when you have the worst 12-month period
Mhm.
over the last 55 years was a difference of 3 or 4%.
Yeah.
So you're defending against something that the difference is so little. You can't say you defended the investor against the bear market. You actually just kept them believing that someday you'll have more bonds and it will make a bigger difference. So
I think this really calls into question the psychology of it rather than the math of it. And some people just have that comfort level. I'm with you. I'm more of, hey, let's have 100% in equities, whatever mixture that looks like for you. And then a solid cash buffer in emergencies. Then I feel like you're covered at any stage of life.
yep. So it's I think you're on the right track. And I've watched a number of your videos. I think they're just terrific by the
you.
way, Aaron. And I got the sense that you were leading them down what I would consider the right path.
Oh, thank you so much. I appreciate that. Touching on how we looked at our children's or grandchildren's portfolio, you questioned whether I was going 100% in S&P. What do you think it is the simplest way for a DIY investor to fix overexposure to maybe the S&P 500? Because I know a very standard default for people nowadays is to just pick the S&P 500.
Well, actually, the S&P 500 has produced a better long-term return than the total market index.
Okay.
And I remember in talking, I had an interview with J.L. Collins. What a great guy.
He's got a fabulous book out. If people, Simple Path to Wealth, Simple Road to Wealth.
Yeah, it is terrific.
Yeah.
And I had to ask. I wasn't being confrontational, but I had to ask, why the total market index? Because it does historically underperform the S&P 500. And the reason is so often mentioned that, well, because you have a more broadly diversified portfolio and you pick up some small companies in the portfolio. And I asked him, then why, if it has small cap in the portfolio, isn't it getting a better rate of return? And he said, I've asked myself that question too.
It's because of how it's weighted.
Well, you're absolutely right. And the reason it makes a difference is because they have equally weighted growth and value. And when you put growth and value together, going back to 1928, and we can track it because of the academics work, it turns out that the poor performance of small cap growth is so bad that the difference between the S&P 500 and the small cap value is in that portfolio is the advantage is wiped away.
Yeah.
So if somebody wants to have the total market index, I would say, don't do the total market index. Do the S&P 500 for 85, 90% of the portfolio, maybe 80% of the portfolio, and just put small cap value in the rest. The difference, the exposure to risk will be virtually the same, but from everything the historians note, that value for the value portion of the portfolio is really where the action is in small cap.
So you're saying I need to rethink my portfolio, which is probably about 80 to 85% VTSAX, total stock market.
Well, I would go out and celebrate tonight if you did. That's how I feel.
That sounds like a big move. I need to marinate on that. I'm not a big sudden mover, but I will take it into consideration. What about looking at a portfolio, looking forward for investors? How can investors realistically predict what their return might be? And what do you teach? How do you teach this without promising too much?
Well, there are some guarantees I can make. But
I like a guarantee.
You like a guarantee. Well, you want to hear a guarantee?
Yeah, let's do it.
You're guaranteed to get the return less a small expense if you put your money into an index fund. If it's an S&P 500 fund or a total market fund. That's a guarantee I can make. I cannot ever make that about an actively managed fund, unfortunately. But I think to create realistic expectations and to build your plan on. I mean, you got to use some kind of a return on your portfolio to figure out, well, when am I likely to reach whatever my number is that I can retire? And I want people to be realistic. We need to understand there's a huge difference in this industry between the courtship, the honeymoon, and reality. And I will tell you that there is almost no courtship that's ever been any better than what Wall Street does for what they want you to invest in, which is why I want people to really get a good sense of what the reality is like to be like. And I think the best reality that I know, for example, on the S&P 500, over the last 96 years, the best 40 years, and that's what we're looking at is long-term investing. The best 40 years was a compound rate of return of 12.5. The worst was 8.9. Now, for those people who think they're going to lose money in the stock market, it tells me that if you put your money in the S&P 500, the odds over the long term of losing money are very, very small.
Yes.
No guarantees on that, of course. But I think if you built your plan on the 8.9, that would be a very conservative way to do it.
Yeah.
Now, what's interesting, we always talk about 10% for the S&P 500. But we have to remember that does include the Depression going back to 1928. What we find is the 40-year average return of the S&P 500 is 11. Because when you look at 40-year periods, after you get past that first 10 years, everything's not hunky-dory, but it's pretty doggone good.
Yeah.
And so to me, that is a way of looking at the kind of guardrails on the bottom and on the top. Now, then, if you're a student of our work, you'd want to know what that range might look like on small cap value.
Yep.
And that runs, believe it or not, 11 to 16 with an average of around 13. So historically, there is a premium for small value companies, according to the academics. I didn't make this up. I just went to their classes, and there is a premium for the S&P 500 compared to being in bonds, and it's, by the way, about a 7% after inflation premium.
Yeah.
And so whether you got 8.9 or 12.5. After inflation, it was still around 7.
I'll take it.
So which would be great if we could get that over a lifetime.
So I think just get invested. You'll capture what you capture, but it's probably going to be better than what you thought is kind of the philosophy I go with.
Well, it's better than what people think compounding can do. When I teach high school classes, I ask them what they pay for a piece of bubble gum. And they tell me they pay 5 cents or 20 cents or 50 cents.
Yeah.
And I go berserk. I just said, that cannot be, because when I bought bubblegum, it was a penny.
Yeah.
And then we talk about inflation. And then I say, okay, if a 5-cent piece of bubblegum inflation rate it was based on an inflation rate of 3%. What would it cost for a piece of bubble gum 2,000 years from now? And they start guessing, and they never get to $2.3 trillion billion. And that's because our mind just does not think about the power of compounding.
Well, we get so anchored to where we currently are.
Right.
That it just kind of becomes this tether. We can't really project too far beyond our anchor naturally.
And I think young people have a real challenge with that, because when we're talking about building, and I show ways to build $5 and $10 and $20 million portfolios without a college degree. I mean, if that's how you're looking at investing, but the fact is that if, let's say, you're going for a 10 or 12% return, and at the end of the first year, you're only get a 2% return. Well, it feels like you're not on your way to $1 million. There's no evidence. And then if the next year you get 10%, you're still not where you think you should be. But if you just wait for 10 or 20 years, all of a sudden you see you're way beyond where you thought you legitimately would be. And then it's almost a cakewalk if we can get you committed to believing that it can be done. And when I was an advisor, I found that if people in the first year of that investment did well, it was huge in building their trust that it was going to be good for the rest of their life. On the other hand,
on that.
and
No, go ahead.
the other,
I'm speaking on that. I feel like there's a quote that kind of fits in all aspects of life and with investing, that we underestimate what we can accomplish in a year. Or no, reverse it.
yeah.
We overestimate what we can accomplish in a year and then underestimate what we can accomplish in a decade's time. And I feel like that's the thing that people get stuck on with investing. They don't see these huge movements very early on, and then they get frustrated and they're like, oh, it's never going to be 1 million. I have 10,000.
And you and I try to teach people that successful investing is not about being smarter than anybody. But when somebody has invested and they made very little, and they look at other people and things that made a lot, they're going to conclude those people know more than they do. And so they, well, no, I've got to know more to be a good investor. No, you don't. And
my path to putting money away has been so incredibly boring. Like I have done nothing fantastic.
And then when the market goes down and you think, God, I could have gone on a vacation somewhere. And I've seen couples almost come to fisticuffs over what that money they lost could have done in their lives. And so they make up this story about next year's going to be just the same. Let's get out now.
Yeah. I've heard it. I just stay in though. Just stay in. It recovers. Like long term. We think long term. I know, like circling around this topic, you're a proponent of saying, the past might slightly mirror the future. And a lot of people are always attaching to the narrative of like, oh, we used to get 8% or we used to get 9%. We're not going to get anything like that going forward. The economy is so different now. What are your thoughts on that?
Well, to begin with, we didn't get 10% in the past. We got periods, for example, from 1975 to 1999, the compound rate of return was 17.2%. Then people look at that and say, whoa, I can retire really early if I can get that for the next 25 years. For the next 25 years, the market made less than 8. Even though right now what we remember is this great run we've been on since 2010. But that's the way the market is. Periods of underperformance, periods of outperformance. And so that's another expectation that is so out of whack that there is in this process of investing in equities some sort of a relatively straight line. And when you look at it from way back, it looks like it's fairly straight up. But it is not straight up.
Isn't it Rick Edelman who said that it's kind of like walking a yo-yo up a mountain?
Yes. Yes. And the question is, have we trained investors, both of us, have we trained investors to actually understand what it's going to look like? We have tables that show how bad it can be. So if you look at our table about the S&P 500 and bonds, we show in 10% increments how you would have done for 55 years with 50% in bonds and 50% in the S&P, or 60-40 or 20-80. We show all these different combinations. But at the bottom of the page, we show you the worst year, the worst 3 years, the worst 5 years, the worst drawdown, so that we can get people to focus on the periods when it's going to attempt to throw you off the train. I mean, that's Bogle said it 1,000 times. The number one thing is stay the course. And anything that we do that keeps us from staying the course is going to hurt us. And so an education is the most powerful thing, but not just about the good times, also about the bad times.
100%. Totally agree with that. One of your books centers around the ultimate buy and hold, or the 4-fund portfolio. How do you get investors to choose the right level of complexity for their personality, their goals, and to stay invested long term?
Well, that's a challenge because we believe that do-it-yourself investors need to know as much as a broker or an advisor, an investment advisor. Why? Because the do-it-yourself investor has one client, and it's the most important client in the world. And so that's why we have over 200 tables and graphs and charts to help educate people about all of that, because you then, it's kind of like a flight simulator. We call it the fright simulator because you need to understand the frightening period you're going to go through. Having said that, if I could know up front, and I don't do a good job about this, and I'm going to fix it in the coming months. I've been at this for 12 years with the foundation. But here's the reality. If I have all this work that I've done that leads you to knowing the right stuff so you can be a good do-it-yourself investor, and none of this is to make money off of anybody, for you. And if you can't take that, if you can't face the reality that you need to understand this stuff, then let's pick a really simple thing like a target date fund. You don't have to do anything more than a target date fund. The Wharton School did a study, and they looked at 1.2 million target date fund accounts at Vanguard. And they found the people that only use target date funds were investing in a way that is built to make 2.3% more than the people who are not using target date funds, which makes me a believer, even there were lots of things about target date funds I don't like. But it works. And so if somebody is really not going to take the time, I just want them to go into a target date fund.
I agree that the target date funds make it so easy. And the data does show that people who utilize a target date fund, they likely don't have investments elsewhere. So usually this is their entire portfolio. My concern around a target date fund for someone who's willing to put in a little bit more work, and not everyone is, if you're willing to put in more work, I think they can be too conservative, especially early on. What are your thoughts?
Totally agree.
Yeah.
So that takes us to level 2. And level 2 says, hey, how about, and we've got a book called 2 Funds for Life, written by Chris Pedersen, our head of research, unpaid, of course. But all we're saying in that book, and my book, we're talking millions. The last half of it is about target date funds. Okay. You want to take more risk? Just add some small cap value, 10%, 20%, 30%. If you add 30% historically, it will add to the S&P 500. It will add about 1% a year. Now, 1% a year on somebody who puts away $6,000 a year for 40 years is about an extra $3.5 million over their lifetime.
Oh, yeah.
I'm looking for 1% anywhere I can find it. And that would be one way to find it.
So now when you say a 2-fund portfolio, you're saying a target date and small cap?
Exactly.
Okay. Are you concerned that there's any overlap when you do that?
Well, the overlap, because in that target date fund, you're typically large cap blend.
Yeah.
So it's a total market index, U.S. and international, and there's no reason to think that the internationals aren't going to be as good as the U.S. I know that people will argue otherwise because recently the U.S. has been better, but there's lots of history when the internationals were better.
Do you
But
have a level 3? So level 1 is just a target date fund.
ah,
Level 2 is target date and small cap. Is there a level 3 or a level 4?
yes, there is.
Okay.
The level 3 would include portfolios of 4
Okay.
of funds in the equity portion.
Hmm.
But now you're into building, well, you could do this with a target date fund if you wanted. But in that 4 fund strategy, if you're not going to do the target date fund and you want to be all equities from day one, there are 2 ways to do it that we know, and we show year by year returns on this going back to 1970 with 25% US blend,
Hmm.
large cap, 25% small cap value, US,
Hmm.
25% small cap blend, and 25% large cap value.
Hmm.
That portfolio, in fact, we show the returns going back to 1928.
Hmm.
That portfolio is way less risky than the S&P 500.
Hmm.
And we have a table to show that, and has a return that's about 1.9% better since 1928.
I'll take 1.9% better.
I mean, it's a huge deal. Now, that's a little work because you're going to be rebalancing that account.
Hmm.
Now, you want to do not better, but do it a little differently. You could do 25% each in those 4 equity asset classes,
Uh-huh.
but make the large cap blend US, make
Okay.
the small cap blend international, make the small cap value US, use the international small cap blend. So now you have half value, half international, you have half small, half large, half
Yeah.
value. It is beautiful. Now, I mean, that's a terrible word to use these days, but it is, I think, functionally
Yes.
doable. And the reason I say doable is because when I was an investment advisor for our clients, we had 10, and we were doing the work.
Hmm.
Clients weren't expected to do anything.
Yes.
So we had 10 different equity asset classes.
Hmm.
The return we found when put to the test by John Bogle, the
Hmm.
return was virtually the same with the 4 fund strategies.
Okay. And so that, I mean, I feel like 4 funds for somebody who wants to do some work with their investing. And I get that there are people out there who just want to put it on autopilot. They're not the ones watching this channel. For some people, a target date fund is good enough. But I think if you're watching this kind of content, you're interested in a little bit more hands-on approach. And I think that seems manageable, even for those who don't want to go all in on everything, you know?
And I think, Aaron, that the fact that they're smart enough, when I say smart enough, that they're able to deal rebalancing
Mhm.
4 equity asset classes, you still then have to address, when do I add the bonds and how much?
Mhm.
Well, that is easy. There are people doing that for trillions of dollars worth of money, or yeah, trillions in target date funds. So
Mhm.
you can replicate, if you want, what Vanguard does, or you can be a little more aggressive and use BlackRock, and
Mhm.
you can do adding those equity asset classes. And the thing too that I think is important for people to understand, if you want to complete the education, you learn the difference between traditional index funds
Mhm.
and non-traditional index funds. If you don't learn that, you're not, I don't think, going to get the value out of doing all this work.
Do you want to speak to the differences between those?
Oh, sure. The traditional is what we know at Vanguard.
Mhm.
And when I talk about the traditional and I go to the Bogleheads and make a presentation, they're always supportive when I'm talking about traditional. Non-traditional are people who build indexes
Mhm.
their own way.
Mhm.
My 2 favorite fund families who do this would be Dimensional Funds and Avantis. And they do not tell you what's in their portfolio. Why? Because they don't want people rushing into what they're buying. They don't reconstitute twice a year or once a year, when everybody in the universe who wants to know knows what's going to be bought and knows what's going to be sold in these indexes. And that costs the shareholders money in that cost of reconstitution. But the people at DFA, and these are academic-based organizations. I don't mean they're run by academics, but they are led by academics in terms of what they accept as the basic beliefs of how to invest. So they don't have to wait until next year at some date to rebalance. If there's a reason in their portfolio to get out now. Or if there's a reason to get in now and do it in a quiet way. If you're buying something, you want to wait until there's a whole bunch of that stock available at a discount. And so DFA they've been doing this for many decades. I mean, what people don't know about DFA is you really couldn't invest with them except through an investment advisor until a few years ago. And not many people understand that their ETFs replicate the work that they do for their clients who can only buy through an advisor who makes. I mean, it's a very exclusive club because it keeps down the turnover. If you have everybody has to go through an advisor. So DFA has been running, for example, their target value portfolio since 2000. It has literally doubled the return of the S&P 500. I mean, double if you put in a $10,000 investment, you had twice as much money at the end of today.
Okay.
That's that index.
Yeah.
Look at the Russell 2000 small cap value. It is barely ahead of the S&P 500. What's the difference? DFA doesn't buy all the worst companies financially in the small cap value arena. They buy higher quality companies. They don't do this reconstitution, as I said. I mean, they take every step. In other words, as far as I'm concerned, and this is not a put down of the people who use the traditional index, they are coming to work and working regular hours. DFA and Avantis are working overtime. They come in every day ready to go to work. And so it's not like this is you, and you do pay a little more, but it's very little more.
What do their expense ratios look like?
A quarter of 1%, let's say, for small cap value.
I think if people thought that it was going to double what they would otherwise be invested in traditional, it's worth a consideration. Are there situations where you would recommend someone just strictly use traditional index funds, or different situations where you would recommend maybe a blend of these two approaches? What do you think that looks like?
Well, I would go right to what John Bogle said, stay the course. And if you use, and we have a bunch of Vanguard ETFs that we recommend, and we have a group called Best in Class. But if you believe in Vanguard and you want to be there, then we'll tell you the Vanguard ETFs that you could use to build these portfolios. On the other hand, you can also buy these best-in-class portfolios through the brokerage firm at Vanguard without a commission. So you can still do business with Vanguard and feel that you have not done anything to make John Bogle roll over in his grave.
I'm a Vanguard loyalist, so I mean, I
understand. And I will tell you, Aaron, that there were many years that I got raked over the coals at Bogle because I was a heretic. But the only thing I am is I'm in favor of doing the right thing for the investor.
Absolutely.
Every penny we can keep in that investor's pocket for a lifetime becomes something in our family, not somebody else's family. And in fact, we do some tables that show what happens if you put away $100 a year. In the table, we show not only what you have the day you retire, we also show you what you have the day you die, because that's part of your return.
Yep.
And what you took out is part of your return. But then that money doesn't disappear for at least 10 years. It's if it's in a Roth IRA, we track the return for the next 10 years based on taking out 5% a year for that heir while they're waiting to take out the balance and not get clipped with taxes.
Yeah.
Those are all steps that can be taken to maximize the return. And this is the big difference between John Bogle and myself. His focus, and I really admire him for this. When we talked for 90 minutes, he never once mentioned doing good for institutions. His work was doing a good job helping people retire with that famous word. It was the name of one of his books, enough.
Yeah.
His mindset was on enough.
Yeah.
Well, my mindset is not on enough, and not because I'm greedy. My mindset is to plan for more than enough. And the reason I say that is because history has it that many plans do not get where they intended. So if you do all the things to make more than enough, and you end up with more than enough, lots of people will benefit, including yourself. But
Yourself,
if
your
things don't
family.
pan out, I mean, we have divorces. Those people went through the courtship and the honeymoon, and they thought that was all going to work out too. And the other fact that people need to understand, I think, to understand what's going on right now with these high-tech companies doing so well, the history of investing in the stock market is, and there's a study by a Professor Bessembinder on this, going back to 1928, out of all the public companies, 96% of them averaged 3% return. The other 4% were the ones, 1 out of 25, that made enough to take the return of the market up to 10, which means that if we don't buy the market, we are at some risk of buying things that didn't turn out the way we thought they were. And when I was your age or a lot younger than you and started in the investment community, lots of people thought you had to own Sears. You had to because janitors could go to work for Sears and put money into the Sears stock plan and retire with millions. But it didn't work out. And there were a lot of things that didn't work out like that. And so my goal for people is to figure out, how do I get to more than enough? And what are the instruments that get us there most safely? Now, maybe losing half of your money in an index fund is uncomfortable, and that's not safe, in which case you need to be in some fixed income to bring the risk down where you can take it. Because if you take too much risk,
if you stay in, you can't lose. Like, it's just a game you can't lose if you stay in.
Yeah. And I will tell you, 60-40, we're working on an article right now, 60-40 for a lifetime. And you can do that with 2 funds. But 60-40 for a lifetime has had a return that would be better than 8%. And then if you did it with the 4-fund strategy and all of that, you would make almost as much money with a 60-40. 60% equity, 40% fixed income, historically, as you would have done on the S&P 500.
That to me is almost shocking to hear.
I know it is.
I can't even stomach turning to a 30-year-old and being like, 60-40, that's where you should be.
Well, I will tell you, people that I have recommended. I had 2 clients. Their parents had left them money. They were in their early 20s.
Yeah.
Money to last for a lifetime. It wasn't enough to go out and not work.
Yeah.
But I suggested from right now, 100% of your money forever in equities, in your IRA and your 401k and your HSA. But I'll tell you, if I understand your parents and what they wanted for you with this money was to be there for you, in essence. They can't be there physically,
Mhm.
but for that money to be there to give you protection from the catastrophic.
Mhm.
And if you want to meet their goals,
Mhm.
I believe, by the way, I knew this was true of the parents, that this was their belief. I believe they would be happier if you put that big amount of money
Mhm.
in a 60/40, like a pension.
Yeah.
And you can start spending part of it now if you want. That's up to you. I mean, here are the tables of what we have, dozens and dozens of tables to show you how it would look if you took money out of them at
Yeah.
3% a year, or 4%, or 5 or 6. But there are people who probably, or let's say somebody who is about to retire in 5 years,
Mhm.
and they have enough right now,
Yeah.
and they've made this because they're all in equities.
Mhm.
And when I was an investment advisor, oftentimes I say, look, I know you're going to work longer because you love what you do,
Yeah.
but you have enough right there that you never have to work
Mhm.
again. So yeah, keep investing all equities with the new money you put in, but I think you should be more conservative and lock in that, in essence, a guarantee.
Mhm. Smooths out the ride, that's for sure.
Yeah.
So many investors know they should stay the course, but emotionally, that's hard. I think people have gotten better at it. I think in the past, there was more in and out, but I think trend wise, we're seeing people are staying the course. What do you think makes this so difficult for people?
Well, first of all, I'd like to tell you why I think they're staying the course.
Okay.
Because
I
they're in
think,
target date funds?
pardon?
Because they're in target date funds?
They're in target date funds.
I think that's a
They're
huge
in
way to,
indexes. They're
yeah.
mostly in index funds today. Um, they are no longer being guided by people who have a tendency to recommend an all or nothing
Mhm.
kind of approach. And they also have lived, many of them, through a market that's been particularly rewarding.
Yeah.
We need to understand that in the 80s and the 90s, that people paid PE ratios that were basically 9% or 9 higher
Mhm.
than what is typical.
Yeah.
So there are long periods you start to believe stuff that it isn't true.
Mhm.
And when you look, in fact, I just give you a number. At the end of 5 years, from 95 to 99,
Mhm.
28.5% compound rate of return for the S&P 500.
Yeah.
28. When asked in some surveys, what do you think the next decade is going to produce? The response was somewhere between 20 and 30% a year.
I remember reading studies that were published around that time,
Yeah.
and you would start to see financial advisors recommend using a 13% as a conservative rate of return. I'm like,
Yeah.
oh my gosh, it just shows the hype of the time.
Yeah. And the higher that people can believe,
Mhm.
the more likely it is for people to take the bait to invest
Mhm.
in an all equity portfolio. When I went into the industry in 1966, Ed came up, a broker, fellow broker. He came up, he put his arm around me, and he said, Paul, I want you to know two things. One is that we're not here to make money for people. We're here to develop relationships that if they wanted to fire us, it would be like trying to kick somebody out of the family. So it was about one, loyalty, building loyalty.
Mhm.
And they teach you how to do it, the tricks of the trade. The other thing is to understand that you're going to make a lot of money as a broker over the years.
Mhm.
But don't wait for a bear market to buy stocks cheap for your clients, because they don't buy them in a
Mhm.
bear market. They don't want to take that risk in a bear market. So the time to sell is when the market is up.
Mhm.
Well, guess where that's leading people? Right down a rat hole, because it is easy to sell small cap value when it's been on a run.
Mhm.
But people say, oh, the last 10 years didn't doing that well. Well, I mean, there's no risk in the past. We always know what we should have done.
Mhm.
The question is, what past do we use as the guide to what we do moving forward? And 10 years means absolutely nothing. So I don't know if I answered your question or not.
I think you did. I think
It's not easy being old.
it's kind of just making sure people have a reasonable expectation.
Yes.
And I often, people are more disappointed. Like if you say, hey, you're going to expect 10%, but then they get 8, people are angry. But if you say, hey, you're going to get an 8% rate of return, and then they get 9, they're like, oh my gosh, this is better than I ever thought.
And remember that nobody can tell you what it's going to be.
What happened to that guarantee we talked about earlier?
Yeah, well, see, remember when the market goes down 50%, so does the index.
Yes, it does.
So I guarantee it. And that's another thing I tell people. If you follow my best advice, I guarantee you'll lose money. And they snicker, but they don't want to hear that. But they need to hear that. And I believe the same thing about marriages, that we all probably would benefit from some counseling during the courtship and the honeymoon period to prepare ourselves for the challenges. Because if we were prepared, I think we'd do better for longer.
Yeah, that probably applies to all aspects of life. Something we touched on a little bit earlier, but I think we should revisit because it's really important. You said that a 0.5% boost can mean an extra $1 million over a lifetime.
Yes.
So how do we stack our portfolio so we can capture as many 0.5% or 1% extras?
That one makes me drool. And of course, that's what the free book is about.
Yep.
It's easy. Think about expenses. When I came into this industry, 95% of the mutual funds that were sold were load funds of the money. And they were charging 8.5%. And that money was gone for a lifetime and the children's lifetime. I mean, it's just amazing that nobody ever challenged me and said, well, they'll say 8.5% is a lot. Well, it's not just the 8.5%. It's the 8.5% sitting there in your pocket, growing instead of my pocket.
Yeah.
And today, almost all the funds that are being sold are no load. And then the expenses. Most new purchases are in the index funds, or at Fidelity, you can get them 0 expense index funds basically, and so that's a 1% savings right there, is in the expense of running the fund. Now then, the next thing we have is somebody like me comes along and says, hey, why don't you let me manage it for you? I'm only going to charge you 1%. Well, when we look at the costs of 1%, that's 2.5% right there. And that's a killer over the long run. It could be yours if you took the time to learn enough to be a do-it-yourself investor. And remember, it could just be do-it-yourself with a target date fund.
Yeah.
Then, so many people are afraid of the stock market. And whether they want to have half in or they don't want anything at all in the equities market, something like 23% of young people don't want any money there. Well, let me just tell you that a $100 investment in the S&P 500, hypothetically, in 1928 has grown to, for $100, over $1 million.
Yeah.
In the bonds, grown to under $10,000. I mean, 10,000 versus $1 million? Come on. I mean, now,
seems like a no-brainer.
Yes, and it is for the long term. But a lot of people are afraid of things. We all know that they don't want to lose money. They don't want to look stupid. They don't want to be dumb. They don't want to be pointed at, you lost us money, all that kind of stuff that goes on.
And the pain of losing money is exponentially greater than gaining money.
Huge. But also look, I mean, the biggest return I ever got was $15,000 I put into one company and waited 30 friggin' years. And it almost went out of business a number of times. Well, or it could have easily gone out of business, put it that way. And that's the way, if you look at the stock market, it's a whole bunch of businesses. It's what Warren Buffett does. He buys 50 companies approximately. We're saying you can buy 5,000.
Yeah.
And these people go to work for you every day.
Mhm.
They get up, they go there, they face all the
When
problems.
you're investing, you're an owner in that. I think that's something you have to hold on to.
And you never have to fire anybody, but you can fire the company
Mhm.
anytime you want without any having to put it on the market to look for a buyer. But here's the thing. When you trust all those companies working to make life better for themselves and for you, not everybody's used to understanding that aspect about life and owning a business. So they have to be taught about how that feels. But here's the payoff. If we're looking for a half of 1%, and I say, 10%, forget about small cap value, 10% in equities, 5% in bonds, that totals up to 10 half of 1%. It's there, it's right there, and you could test it if you can't stand the idea of having money in the market. Put 20% in the market. Do it for 10 years. Lose out on whatever you see for 10 years before you have the strength to or the confidence to add more. And I think those are, and taxes. Oh my God. When I think about what it was like in 1966, no ETFs, no index funds, no target date funds, load funds, high expenses.
And you had to call somebody who was likely in New York or something to get invested. I think we don't appreciate how easy it is to invest nowadays.
And there were commissions were regulated.
You had to buy in round lots. You couldn't just be like, I'm investing $20.
Well, or that's right. They didn't have partial shares like that. And they didn't, the spread between the bid and the ask.
Oh my gosh.
I mean, imagine buying 1,000 shares of IBM and spending $1,750 in commissions.
Yeah.
And having at least 1/4% difference between the bid and ask. All those things are whacking away at you time and time again. And so what you want is taxes, like for our granddaughter, that money that we're giving her going into low cost, all that stuff working for her in the best way that we know how. And then the money gets transferred into Roth IRAs and it compounds for the rest of her life. I could never make as much as you could in the market.
Investing, just the landscape did not look anything like it looks nowadays. And I started investing in the 90s. And I mean, to talk about the change over my lifetime alone, then to look at the changes that went from my mom's lifetime. And my grandma was an investor and she was born in the 1927. So she started investing when she was, in her late 20s and her early 30s. And to go from like what she told me investing was, then to my mom's experience, then to my early experience, even when I was looking at the Detroit news and like picking my stock and had to call an advisor on the phone. Like the world is so different and it's so easy now.
But there's a problem. And the problem is about, I don't want to call it greed. But the reality is, when I was in high school and graduated and went to work as a broker when I graduated in college, there were very few ways to contact people. The telephone, mass advertising was not easy. And most of the people that you were trying to reach only read the comics and the sports page. So, life, and there were no 24 hours. I mean, it's all different. And these people at Google and all of these folks, they are 24/7 figuring out how to part you with your money.
Oh yeah.
It's all American.
Yes.
It's what we believe in. And the problem is a lot of people don't know how to fight that.
Yeah.
And if you can't fight the ability to save, and there are people who live in very low income parts of the world who save 15% of what they make.
Yep.
And we think that's a really, really tough to do that. And the answer, I swear, because it seems to be working, it goes back to what you said about how much better people are doing now, is that automatic sign in to the 401k. You
Yes.
have to opt out.
And now it's officially law on new plans, which I love. I mean, at least we're forcing people to save, because sometimes when left to their own judgment, some people don't start saving. So I like that we have to opt people in.
And I look at how I lived. I got married at 19, and we didn't live as paupers, but we didn't have much.
Yeah.
And when we got out of college and all of a sudden I was making almost $500 a month, we had money to burn, and you want to spend it. You don't want to save it. I mean,
Yeah, you're like, I've worked really hard for this.
yeah. And I, at one point, before I got married, I lived in a luggage, the old luggage place in an old house where they would store luggage. You had to crawl under a pipe. Two of us shared a room for
Oh my
$12.50 a month, but we were frugal. And
I once heard that men can live anywhere, and then it's once they get a woman in their life that they need a house.
why can't a woman be more like a man, huh?
Oh, well, I can tell you, I would not have been willing to live in a luggage closet. So there's
Well,
probably truth
It
to
was.
that.
By the way, I really appreciate my life today, and
Yeah.
and a wife who helps me spend it, because
Yes.
she really loves to spend,
Mhm.
and I don't.
Well, that way you balance each other out.
Yes, we
But
do.
in talking about building this portfolio and building up your investments, the whole goal for most of us, financial freedom or retirement or whatever you want to call it. So how do you know when you have enough? Like, what do you think the hallmarker of that is?
Well, I am a huge advocate of financial planners.
Mhm.
By the way, when I started my investment advisory firm back in 1983, that's before the Certified Financial Planning School was even set up.
Yeah.
And everybody were stock jockeys.
Mhm.
I didn't ever learn to be a financial planner. I was just a guy that knew a lot about the stock market anyway. It took me up. Bring me back to the last question about what you just asked me.
How do you know you have enough to make?
Of course, the biggest question of all.
Yes, the
Okay.
one question in finance that we're all striving towards.
Here's what I believe. I believe that in the struggle to find that out,
Mhm.
that you need to spend some time building your plan.
Mhm.
And after you have your plan as a do-it-yourselfer, you go to a planner and have it critiqued for
Mhm.
what is good and what should be challenged, because there are a lot of questions about when you have enough, because how do you want to live? I tell people, as I mentioned earlier, I want you to have more than enough, because if you have more than enough, I can forget about worrying about inflation. We can just take 5% out of twice as much money as we ever needed anyway, and I don't worry about inflation. And I get to spend more so that what's enough depends on what you want to do with your life.
Yeah.
My wife and I are committed to leaving a bunch of money to Western Washington University, to the Merriman Financial Literacy Program, where we are helping to educate every student at Western on finding about 30 to 40 hours worth of financial literacy a year to get out of jail.
Yeah.
But the fact is, what you want to be is important.
Mhm.
And more important, and the part of the business I loved was anytime I did these workshops, 3 to 6 hour workshops, anybody who was sitting with me for 3 to 6 hours got a free consultation. I've told them how to do it. They come in, I look at their portfolio, I tell them where to go from there. But in that hour and a half I would spend with them, I'm sitting with a couple. And typically one is loving it and the other one is bored to death, but has some strong feelings when it comes to how much you want to spend and what you want to do for grandchildren and all those commitments you can make. I loved that conversation.
Yeah.
And what I used to do, it was just a personal gimmick with myself to entertain myself. I would make notes like mad. We don't have these kinds of like jump, I think it's called, where they're recording the conversation and then dictating what needs to be done for the prospect.
Yeah.
But I would take all these notes. I would then turn the page over, and I'd say, I want to note if I really understand your situation. And then I would just tell them back what they told me. And here's what I would do. And of course, if I missed something, I just felt terrible. But it was a game I played with myself. I never told them that I would celebrate if I got it right.
I think that's probably one of the best things you could have ever done to build the relationship, because that was a way to show, hey, I'm listening to you. I'm playing it back. Make sure I got this right. Why don't you fact check me and tell me where I'm wrong?
And as you know, retirement is a lot more than just what the distribution might be. It's the distribution, early years, latter years. There's a whole bunch of stuff. I want everybody to be able to sit with an hourly advisor. I like the hourly advisor. I like the hourly only advisors best of all, because there's no conflict of interest.
Yep.
I tried to hide behind the idea that I would tell them what to do on their own.
Yeah.
So I didn't have a conflict of interest. I always had a conflict. Somebody sitting there with $10 million, obviously you realize that would be good for them if we did it, because we knew it would get done.
Yes.
And then the money would be good for us for doing the work. That's what we were there for. But I think spending $500 to $1,000 to have somebody review what you put together.
Yes.
Now, it's going to cost you probably a little more, but there are some people right now. There's a guy named Mark Zoril has got an organization. You get the initial. They have you fill out a form. Then you get a about $400 cost to have somebody, a CFP, sit with you and go through what you should be doing. And it's trying to cover all the bases, the big bases. That's great. Now, they know a lot about you because you filled out all the paperwork. They don't spend any time with you. You do that before you meet with them. Then they meet with you after they've had a chance, $400. And for ongoing advice, $8 a month in the second year on. And you can call anytime. They got a tax person on staff. That's what's coming. I mean, this is the changes. The most valuable, it will not be an investment advisor anymore. It will, as a 1% kind of investment advisor, it's going to be the hourly person. Now, yes, there will still be people. I don't care if you're going to make $3.5 million more by paying somebody 1% a year. But most of that kind of business is going to be in the hands of a robo-advised fund. And that's all a target date fund is a robo-advised fund.
And I would say the vast majority of this channel is DIY investors. They're the people who really want to be hands-on. And I think it's great to have someone check your work, basically, as you're getting to retirement. And a lot of people are looking for that hourly advisor. But before we get to that point, what do you think people should do? If they're a DIY investor, what do you think, if you could distill it down to 2 or 3 things that they must know or must do to take care of their situation, what do you think that is?
Well, this is cheating. But that book, we're talking millions, 12 simple ways to supercharge.
Which we can put a link for down below.
Okay. I only mention that because I think you should make sure you understand those 12 things. They're all dirt simple. I mean, it's not a one of them. I don't teach high school kids and they get it. So I'm not afraid of people being able to read. And they may not want to believe stuff that I say, but at least there's evidence that those 12 things are
Yeah.
$1 million decisions. So that's one. Get an education. That's what's behind that. The second, I think, is you need to somehow understand the psychological aspect of money. And whether you read a book like Your Money and Your Brain by Jason Zweig, or some other book about all of the research that's been done on money and your mind.
The Psychology of Money is a really good one.
Yes, it is. Absolutely. Another really good one, too. And so you've got the mental, and then you got and you know the numbers kind of stuff. Then you need to make sure that you and your significant other are in agreement. Now that is, that isn't going to be a make and break, because in some cases that other person just doesn't want anything to do with it. My wife has an MBA, but I have to work really hard to get her to take the time. She's way smarter than I am. She reads books. I read articles and books on investing.
Yeah.
She is much smarter than I am. But she just trusts that I'm going to do that. So, but in most cases, those three things, if you can get those down, hopefully you're ready to go earn that 3.5 million yourself and keep it.
I love that. I think that's a great message. And I think that's a really good stopping point. So I want to say thank you so much for being here.
It's a pleasure. Thanks, Erin, and good luck good luck to all of the people who follow your work. They are blessed. Thank you.
Well, thank you. Thank you.